All right, so we have a lot to cover today, so I'm going to get started on this. I first want to just thank everybody for joining our webinar. I see a lot of familiar names as I kind of go through the participants, and now that we're in January, it's almost been a year that we've been going through this program already. It's been a quick year for a lot of us, long year for a lot of us, but I'm really happy to see that we are getting such great participation from everybody. So I just want to say thank you for joining us. Um, a link was sent out to all the participants with a copy of this presentation as well. You can find this and all of our other material on our website, sereniandassociates.com/coronavirus updates. We will be putting out additional guides on both the PPP2 program and the Employee Retention Tax Credit, along with the overall webinar on our website at some point later on today. For any accountants in the room, if you would like CPE credit, please email Kelly at Cerini at serenicpa.com for a certificate. All information here is actually through January 7th. At about 11:15 last night, the SBA decided to do the SBA thing and release brand new guidance on a lot of this stuff. Luckily, it wasn't too earth-shattering and was somewhat predictable. So I have been able to update that. So this has been updated through the most recent guidance that's been updated this morning. Once again, this is based on our interpretation of the CARES Act because the CARES Act still does play a lot into this as amended. The Consolidated Appropriations Bill and related acts, after reviewing the law and consulting with our other sources, nothing in this webinar can be used to contest any IRS, SBA, or other penalties. It is for educational purposes only. I'm sure there are a lot of questions. We will make every effort to answer questions at the end of our webinar. And I want to say once again, thank you for your attendance. So what we're talking about here is the additional coronavirus response and relief package, part of the overall appropriations bill that was signed on Monday, the 28th or 29th, after passing on the 21st, really focusing on the stimulus provisions for businesses and nonprofit organizations. 30 seconds of shameless self-promotion here. I am a tax partner at Cerini and Associates LLP with over 10 years experience. My industry expertise includes healthcare, financial services, technology, professional services, and I do have a specialty in both state and local taxation and international tax issues. So we're going to be covering three main areas during this presentation. The first one, which I think is of interest to many people, is going to be the changes to the Paycheck Protection Program, PPP loans, and the second draw loans. The second item we're going to discuss is going to be the Employee Retention Tax Credit changes and the expansion. And then finally, we're going to cover some of the other miscellaneous provisions that are in the package as well. Those are our three kind of areas we want to go over today. So jumping right in, starting into the PPP changes and the second draw loans. So the majority of these changes come from a part of the bill called the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. And when I think about these changes, there's really kind of two categories to them. There is changes to the existing original PPP loans, particularly the terms, largely focused on what you can spend the money on. And then there is an expansion to create second draw PPP loans. Along with that, there was a much needed and desired change to the taxation of the program that was a source of significant controversy and frankly heartburn for the better part of the last couple months. So those are the main kind of things here. But when we talk about this, we have the changes to the original program and the expansion to the program. Now, a lot of the changes to the original program also apply to the expansion as well. So just keep that in mind as we are discussing everything here. So the first item here has to do with the changes to the PPP loan program. And the biggest change here is that we now have 4 more categories of eligible expenses that can be used. These are going to be covered operational expenditures, covered property damage, covered supplier costs, and covered worker protections. I recall during, some of our spring and summer webinars, a lot of questions were being asked about, can this be covered? Can that be covered? Hey, can we do this? Can we do that? I think these changes were designed to address that. Maybe this is too little too late for a lot of borrowers, right? For anybody who got a first draw PPP loan, you've already spent all the money. I would be very surprised if you didn't. So maybe this is a little too late, but for borrowers who are maybe having trouble getting to full forgiveness and or maybe are eligible for an employee retention tax credit which will cover down the line, some of these changes could help you significantly. So when we talk about covered operation expenditures, they're talking about software and cloud computing. Now, if you've been to one of my prior webinars, you'll know that I had said that cloud computing potentially was covered under the lease of personal property. I still think I was correct in that interpretation, but now you have a very clear statement to that. Any costs you incur for payroll processing, so those payroll processing fees, any outsourced human resource costs you have, any sales or billing functions that exist, um, paying your handsome and talented accountant like myself, and inventory management. All of those are now covered operational expenditures that you can use PPP loans for. When it comes to covered property damages, these refer to damages that occurred due to the quote unquote public disturbances that occurred during 2020. So, if you had a storefront with shattered windows or similar items as a result of some of the unrest that was occurring, you can now use PPP funds to make those repairs. The third category is the covered supplier costs, and this is an expenditure for goods or a supply of goods that are both essential to the operation of the entity and either purchased pursuant to a contract or purchase order in effect before the covered period, or with respect to perishable goods, think like food for a restaurant, at any effect, in effect at any time during the covered period. So that's what these costs are in particular. Again, I think there's going to be a little bit of questions and controversy when it comes to what does it mean essential? Can I do this? Can I do that? The guidance that came out this morning pretty much gave the same definition that was in the bill. I would be surprised if an FAQ update didn't come around at some point in the future that could potentially give some more clarity on this. If I were going to apply myself to this, I would still, as I have been saying all along, use your best judgment when it comes to this. The program, and they repeatedly emphasize this during the most recent IFRs that came out, interim final rule, which is the SBA guidance, is these are borrower certifications, right? You are certifying that you spent it on this and that they were eligible costs. It's really in your interpretation or judgment of what the SBA regulations are. So, using your best judgment is of crucial importance there. And finally, there are covered worker protections, which means an operating or a capital expenditure to facilitate the adoption of any OSHA, CDC, or state or local government order. So this will be ventilation systems, increased outdoor spaces, a drive-through window for a restaurant, employee PPE, anything that you kind of had to buy or change up that you weren't going to do prior to COVID-19. I know that we're fortunate enough to be in the office, and every 5 feet we have hand sanitizer and we have boxes of masks floating around just in case someone forgets to put one on. So things like that very much would be covered under these items here. These changes are retroactive to any PPP loans, assuming no forgiveness has been requested. So if you've already done your forgiveness, that's it. You're locked into it. You're forgiven. You're done. Um, in the If you haven't asked for forgiveness, then these changes are retroactive to the to the passage of the act itself. These costs are included in your 40% non-payroll cost allowance. So again, you still need to maintain the proper splits. These fall into that 40% category. Every now and then, I still find we get some questions or confusion when it comes to the PPP use eligible expenses. So, just to kind of refresh this real quick, at least 60%, but it can be more, must be in payroll costs. These are cash compensation, health benefits, retirement contributions, state and local taxes. I don't want to get too far in the weeds on these, but these are at least 60% of the cost. It could be 80%, it could be 100%. And then you have the at most category. At most, but it can be less, 40% can be spent on interest on mortgage payments, rent, utilities, and now these four new categories: the covered operations expenditures, the covered property damage, the covered supplier costs, and the covered worker protections. So that is, the big change when it comes to the existing loans, and particularly in the use, is what you can use it for. You now have more permitted uses to it. Like I kind of said in the intro, maybe it's too little too late, but with some of the other changes and the second draw loans, because these are all second draw eligible as well, maybe this, can help borrowers. And I think that's what the intention here was. The next major change to the original PPP draw program was a simplified forgiveness process for certain loans. Now, if you've again been to past webinars, I've said that something's going to have to give somewhere just because of the nature of these, right? For smaller borrowers, the administrative burden just seemed way out of whack with what they may be able to do. So now there is a rubber stamp, quote unquote, process for PPP loans of less than $150,000. So if your loan is less than $150,000, you are now eligible for this new process. There will be a new forgiveness application that, per the law, is due out within 24 days of passage. So that should be right around February 2021, right around there. Oh, sorry, 45 days is not 24. That's why I have February. I put the wrong number. It should be no longer than one page. So if it's when they release it, it'll be a one-page, very simple form asking for main things. They want to know the number of employees you retained, an estimated amount spent on payroll costs, how much your loan was for, and your borrower certifications. Um, you don't need to submit any documentation with this. Give the one page, sign the one page, and you're done. When they ask for number of employees, any number that is reasonable is fine. Don't go too crazy worrying about that question. Estimate it and call it a day if you could fit into this category. So for all the borrowers that I said, hey, things are changing. Let's make, before we get too crazy in applying for forgiveness, this is what I was talking about, is something like this. Would I love if they expanded this even further? Yes. Original drafts of the bill actually had a very similar provision for loans less than 2 million, but I think that got struck down pretty quick. Um, don't know if it's going to change or not any further, but just kind of goes to show. And I think overall, my approach with this round of PPP has been, let's learn from the past, in that there was a lot of changes leading up to those first PPP loans, right? We remember, the application itself changed the night before. There were constant regulations, this and that, just, so many things that we didn't know, we were trying to guess. And a lot of sleepless nights and hard effort, by our team and your teams to get these together, and everything kept changing. So I said, let's kind of learn our lessons from the first time and let this kind of play out as it did. And I think that's kind of where I was going with the forgiveness process too, is, things is constantly in motion. Things are changing. So keep that in mind here. Now with this simplified forgiveness too, you must maintain your payroll records for 4 years, your other expenses for 3 years. I generally recommend you retain all records for 4 years anyway, as that kind of covers the tax statute of limitations. So that's where my advice comes from on that. So that really shouldn't be too much of a change for borrowers. But I think for less than 150, this is a home run. I mean, this is, for a lot of these small independent contractors and smaller companies, this makes life just so much easier. I'm very happy that they were able to get this. So now just some other miscellaneous PPP loan changes. So there is an increased eligibility now to include 501c6 organizations, so professional organizations like that, and tax exempt destination marketing organizations. There are some eligibility limits when it comes to lobbying activities with these organizations, in that no more of 15% of your receipts can come from lobbying. No more than 15% of expenditures can be spent on lobbying, and no more than 1 million can be spent on lobbying in the previous tax year. These are first draw loans, so they're going to go under the first draw loan rules, which is going to be the average monthly payroll times 2.5, no regard for the gross receipts item, which we'll cover with the second draw loan. One change that I did not make here that came out as part of the regulations this morning is you can use calendar year 2019 or 2020 on these first draw loans. They basically said, okay, 2020 is over. We're now going to allow you to use 2020 if you want as well. The SBA has 45 days. I'm sorry. The EIDL grants, those $10,000 grants that came out as part of the EIDL program. If you recall, there was two kind of separate programs, the PPP and then the EIDLs. EIDLs were uh, up to, it was supposed to be up to 2 million. Anything more than 150,000 required a personal guarantee, and they were going to give you $10,000 upon 3 days of application. So that's what the law said. What happened in practical terms was the loans were capped at 150,000, which was the amount of a personal guarantee, pretty much amount before a personal guarantee was required, and they made the EIDL grants $1,000 times the number of employees that you had. So didn't quite work the way they were. But those $10,000 grants were also supposed to reduce forgiveness amounts. That has not happened now. That has been completely stricken from the act. For anybody who has gotten forgiveness already and had to reduce their forgiveness by this $10,000 amount, per the regulations this morning, the SBA will be funding the lender with interest, who will then fund you to give the forgiveness on that. I'm sorry, will fund the lender with the interest in order to have you have the forgiveness when it comes to that. So, if you had a $170,000 PPP loan, of which you got forgiveness of 160,000 because you had a $10,000 grant, that remaining 10,000 will now be forgiven. For any borrowers that had loans over 2 million, which is where the real target line is with this, the SBA has 45 days from the enactment to release its audit plan to Congress. So we've been waiting for the larger borrowers to say, hey, you guys say you're going to review these things. What are you going to do? What do you want to see? How are we going to get ready? Borrowers that have that did get to see the SBA Monday morning quarterback questionnaire about loan necessity come their way. So that, struck a little bit of concern in some of these borrowers. And now we're going to see what this audit plan looks like, hopefully within the next 45 days. And I think knowing what we need to do will be a relief for a lot of borrowers, especially as we now start to get into forgiveness season for a lot of borrowers as well. Finally, they codified, put into the law that group insurance payments were specifically included as eligible payroll costs. They covered this in some prior related guidance, FAQs, things like that, but now it's explicitly in there. It includes dental, vision, group life, and group disability. Dental and vision we definitely knew about. I was a little surprised that group life and group disability counted. Any more number to help is always great, but that now all four of those officially count as eligible payroll costs. So that kind of covers the program changes. Now to kind of one of the granddaddy changes, the headline changes. Expenses paid with PPP loan funds are now fully deductible for federal tax purposes. So if you recall, the IRS came out in May and first ruled, okay, you're getting tax exempt income, therefore your expenses are non-deductible, which is the same kind of logic they would apply if you have tax exempt bond income and you have interest income to go against it, right? Saying if it's not taxable going in, it shouldn't be taxable coming out. This was clearly counter to the congressional intent of passing this program. It was stated this was counter to the congressional intent. It put a heavy burden. It made our planning very difficult. And we all kind of said, okay, yeah, they said that, but they're going to fix it. They're going to fix it, right? Come November, same thing. The IRS doubles down on their position and says, hey, you cannot deduct this. And as a matter of a fact, you cannot deduct it in 2020, the year you used it, if you had a reasonable expectation of forgiveness. That just kind of sent everybody into a real panic, right? Because we were looking at these planning numbers for a lot of our clients. We would see just massive increases as a result of all of this. So they have now come out and said in no uncertain terms that these expenses are now fully deductible for federal tax purposes, and equally important for any pass-through borrowers, your LLCs and your S corporations, also allows for an increase in your basis on the tax-exempt income. So basis is a topic that I could spend probably the rest of this webinar going over. In layman terms, it refers to how much your skin is in the game for tax purposes. And it's basically calculated as your contributions plus your income, less any deduction, less any losses, less any distributions on an S corporation. So what I'm worried about is you have this still unforgiven debt financing that maybe either generated losses for your business and or could have allowed you to take distributions that were more than your net income this year as a result of, your company was maybe less profitable than it was, but your cash flow wasn't as impacted, right? So S corporation in particular taxpayers need to make sure that they don't have a potential basis problem that can exist. LLCs that are taxed as partnerships have less of a concern because debt technically counts as basis for the purposes of the calculation. It doesn't for S corporations. It is just something that, if your accountant mentions it to you, or something that needs to be looked at, just know what they're looking at here is, do you have enough skin in the game in order to not have distributions that could potentially have a taxable impact to you beyond earning them? So, I am a little worried about that for a few clients here and there, but those are bridges that we will cross when the time comes. It's just something that you want to make sure you keep an eye out when it comes to this. Okay, so if you'll notice, I emphasize that this was deductible for federal tax purposes because amongst tax professionals, there is a substantial uncertainty as to whether or not the federal PPP deductibility will flow through to New York State and New York City tax returns. Now, I'm focusing on New York State and New York City because I'm imagining the majority of our attendees are from New York State and New York City area. So that's going to impact them the most. Other states have other rules. For example, Connecticut has no issue with it as one of the closer states. Don't know about Jersey off the top of my head. I don't want to get too tax boring with this, but traditionally, New York State and New York City have had a rule where they said, okay, whatever changes in the federal tax code, we'll adopt that, right? It's called rolling conformity. As part of the New York State budget in 2020, New York State said, okay, for changes between March 1st, 2020 and January 1st, 2022, we're not automatically going to conform to those changes. So that means that a lot of these CARES Act provisions with net operating losses and excess business losses that the IRS got rid of as part of the CARES Act maybe doesn't exist for New York State. Now you have this item coming up where, hey, did this change the federal tax code? I have looked at it a little bit, and one thing I have been saying is, hey, guys, this didn't change the federal tax code. It changed the Small Business Act by saying what the intended tax treatment of these is. So I don't necessarily know if this is a problem right now. I would really love for New York State to issue guidance on this because I think there may be even a degree of monsters under the bed here. But after the year we've all had, that kind of feels natural to me, I think. So, you know, As of right now, I can't give you a definitive answer if it is or is not going to be allowable for New York State purposes. There is a substantial uncertainty to it, and those are bridges that if we don't get guidance by March or April, we will have to cross at those times. But that's a lot of time between then and now, and I would really expect to hear something on this because I'm of two minds. One is New York State feels for businesses and organizations that are being pummeled. On the other hand, New York State itself is getting pummeled, and they may be looking for more revenue, right? Like that could be their way of saying, okay, hey, we need all the dollars we can get. No, 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 tax them on this. California has said that, so that's one I know. California has outright said that they're taxing you on this. So, there's going to be some interesting state and local tax issues that are going to pop up in the next 6 weeks. Right as we head into just the busiest time of year. No big deal. I'm not worried about it at all. This is fine. Um, but yeah, so you got the federal piece, which is the majority of your income tax. But just remember, the state side of it may still have an impact as you start to plan your fourth quarter estimates, as you start to look towards what your April tax bills are. Just know that there could be a surprise lurking around the corner that we need to start thinking about. Really hoping there won't be though, because it's going to make life extremely difficult for taxpayers and tax professionals. Okay, so now, right as we hit 11:30, I'm going to start talking about the second draw PPP loans, right? These are kind of the second headliner of this, is saying, all right, people are still hurting. Businesses are still suffering. What can we do to help? I know, let's have a second draw available on these PPP loans, but unlike the first go around, we're not going to assume everybody's impacted. We're going to put in some additional eligibility criteria. Okay. So the second draw eligibility, right, basically goes into four categories. Number one, you still have to be a business concern, not for profit, or an independent contractor. It's basically, and the SBA has said this, substantially the same eligible borrowers as the original PPP draw. So if you are eligible under the first round, you're going to be eligible, at least in terms of being an actual eligible borrower in the second round, right? So if you were a business that, say, got illegal gambling receipts, which I don't think anybody actually admits, you were not an eligible borrower in the first round, you wouldn't be an eligible borrower in the second round. If you were, one of those businesses that's on the list that the SBA said was ineligible in the first round, you're still ineligible. You still have to meet that first bar that you were an eligible borrower from the original draw or first draw PPP loans. Now we have the employee size. The employee size has gone down. The original PPP loans allowed for 500. These only allow for 300. When we talk about employees, we're not talking about FTEs. The SBA standard has, in the original CARES Act, and generally speaking, has always been all employees on a full-time or part-time basis. They normally look at the prior average monthly employees over the prior 12 months. That has been their normal standard for evaluating. So if I was near, it's going to be one of those things. If you have 100 employees, you're not going to be eligible. If you have 500 employees, you're not going to be. Oh, I'm sorry. You have 100 employees, you will be eligible. If you have 500 employees, you're not going to be eligible. It's those people in the middle that are going to need to really dig a little bit and take a look at it. And again, the calculation is going to be all employees, average monthly over the prior 12 months is the typical SBA standard, and what I would advise people to use when it comes to evaluating employee size. When we talk about the original draw PPP loans, one of the requirements is that you must have used, but you don't necessarily have to have gotten forgiveness yet, all of your first draw PPP loans. So they're not going to let you double dip and say, oh, I still have some original PPP loan remaining. Or more likely, what they were trying to really target was you have these newly eligible people, or maybe people that didn't go the first time that now want to get a bite at the apple. and they don't want to give them double loans, right? So you have to use on eligible uses all of your first PPP loan. You have to actually certify that as part of your application. If you've been coming to our webinars, you know what the eligible uses were, and I would really hope that if nothing else, you took away that you should use all of your PPP loan on the eligible uses. Finally, you have the one that I think is going to be the biggest line in the sand for borrowers, and that's this gross receipts test. You have to show a 25% decline in gross receipts in 2020 versus the same quarter in 2019. So that means I compare first quarter 2020 to first quarter 2019, second quarter 2020 to second quarter 2019, so on and so forth. And it can either be in the first, second, third, or fourth. If any one of those quarters is down, you're good. Or as of this morning, to make your life easier, if you have a 25% decline annually, you're good. And the reason they're saying that is if you have a 25% decline annually, you would have inherently had to have had a quarter that was 25% down. So it could make life a little easier rather than trying to figure out all four quarters. If you were down, you were down. So one thing about the annual that I didn't see addressed that I had written in my notes that I was hoping to see is borrowers who were not in business for all of 2019. Now, because it came out late last night, I only had a chance to read through it once, and haven't had a chance to digest as much commentary on this as I would have liked prior to this. So maybe it was addressed and I missed it, but that's kind of a more specialized situation that may or may not exist. Okay, when we talk about gross receipts, what we're talking about, I have it separated two categories here, your for-profit entities and your nonprofit entities. When it's your for-profit entities, we're talking about your sales for goods, your receipts from services, your interest, dividends, rents, and royalties, right? Those are what your gross receipts are. They do not include any loan contributions. So if you loaned the business money or took out a business loan, it explicitly excludes in the SBA statute capital gains. It would exclude any owner capital contributions. Very importantly, excludes PPP loan forgiveness because that became a immediate question amongst professionals is, well, if people have this forgiveness, that could be a problem. It excludes any sales tax collected and also excludes any amounts that you collected on behalf of somebody else as an agent, if that happens to be in your line of business. There were a few specific examples within the IFR, a little more granular than I think we need to go into right now. In case you're curious where they came up with this, it's the SBA 121.104 size regulations, right? So they're basically saying, all right, you take your investment income plus whatever sales you had, that's going to be your gross receipts. When it comes to what basis you should use, they said whatever basis your applicable accounting basis, I believe, is a term that they use. There are a lot of references to tax forms within the IFRs the SBA put out last night. I would say you can either use your book or your tax numbers. My feeling is most lenders are going to be looking more towards the tax side just because they have more familiarity with it, and a better understanding of how it works. I believe you can probably use either in the end. Again, borrower certification of all of this. So keep that in mind. And I think so long as you're in good faith, that can work. They haven't, again, they said whatever, your underlying accounting record state is what you should use. And am I biased as a tax guy? Probably, because if you ask Ken Cerini, he would say you should use GAAP numbers, and because he does more financial statement work. So really, there's some bias in there, yes, but I'm thinking from a lender perspective and the fact that I saw the emphasis on tax returns. Now, many borrowers don't have separate book versus tax accounting methods, but there are quite a few that maybe keep their books on accrual basis, but use the cash basis for tax purposes. So one of those could be down 25, one of those might not be. Usually one will hopefully follow the other. So just keep that in mind. Now, when we talk about the nonprofit entity, they used the Internal Revenue Code to be their guide on this, really focusing on what is reported on Form 990. So they used IRC Section 6033, which is the information return section, aka what you report on a 990. So a nonprofit entity should include contributions, gifts, grants, or other similar amounts, the gross amounts of any dues or assessments, gross receipts from any unrelated business activities, and any investment income, interest, dividends, rents, and royalties. What can be excluded, because these are excluded on a 990, include the value of donated services, unrealized capital gains, and PPP loan forgiveness. I am unsure if capital gains themselves do or do not count. As I read through, I kept having different interpretations. The fact that it's excluded for profit entities would lead me to believe that nonprofits should probably get the same treatment. If you kind of look at these as a real parity between what these are, between a for profit and a nonprofit entity. So, as far as I'm concerned, they're probably going to work the same way. But that's what they're looking for. Basically, all the money you take in is what they're looking for on gross receipts. Um, I don't think there's going to be anything that discusses restricted contributions. I think that's going to be maybe too granular for the SBA. So, however that's accounted for on a 990 would be how I would say you would have to look at it here. So, I know that's probably going to be a point of contention amongst the nonprofit sector. I just don't think the SBA is going to have a real pulse on that like they would for other things. You have to remember, this is really one of the SBA's first forays into the nonprofit community. So they're not as familiar with some of your specific needs. So now, looking very quickly at this gross receipts calculation, right? So I have kind of just four simple examples here just to show what's going on. In my first example, I have a borrower who in second quarter 2020 was down 28.57%. The rest of the quarters, they were down, but they weren't terrible. But they had one quarter, that second quarter 2020, when COVID was COVID, really hit them. So now, because they had that 28% decline, they may be an eligible borrower based on the gross receipts. They could have employee issues, they could have other eligibility issues. Just saying on the gross receipts side, they're good to go. My second example here, I have a borrower who was down and down fairly significantly in each quarter, but not any one of these quarters was down 25%, so therefore they are not an eligible borrower. Next, I have an organization that was not in business during the first two quarters of 2019. There are special rules for borrowers who are not in business during the first two or three or four quarters of 2019 that I'm trying to demonstrate here. So if you were not in business in the first or second quarter, you can use the third or fourth quarter 2019 as your comparison period. You would obviously wish to use the lesser one. If you weren't in business in the first, second, or third, you can use the fourth quarter of 2019. So in this borrower's case, they have a 48% decline versus third quarter versus second quarter 2020. So they may be an eligible borrower. Finally, I have a borrower that was not in business at all during 2019, had a very strong first quarter, but had a 47% decline in second quarter. This organization is eligible because their second quarter was able to compare to their first quarter. Only that one can use 2020 comparative numbers, and it's only the first quarter. When you think about it, what they're trying to say here is we're not trying to help your business maybe declining, but rather declining versus where it was once upon a time. And, comparing to 2019 and using 2019 back before all of this really struck us is really why they're using that as their kind of base period. Okay, so now going into the second draw PPP loans. So the loan amount is going to be your average eligible monthly payroll costs, calculated the same exact way you did the first time, using the same categories at least, times 2.5 for a maximum of $2 million. You have three measurement period options. You have the last 12 months prior to the loan being made, you have calendar year 2019, and you have calendar year 2020 available for you now. Calendar year 2020 becoming available was one of the changes this morning. If you are a restaurant where your NAICS code starts with 7.2, you can use 3.5 for the draw amount. If you use 2019, you won't need to give any additional documentation, assuming you use the same borrower. Also, if you're experiencing a 25% decline in revenue for any one of these quarters, it is likely that your 2019 payroll costs are higher than your 2020 payroll costs. A 25% decline would probably result in, equal declines in staffing patterns. So to me, I think somewhere in the neighborhood of 80 to 85% of borrowers will end up using 2019, both for its administrative convenience and because it's probably going to be the higher number. So as far as I'm concerned, that to me is the real, where you're really going to want to go. But again, it's the same exact calculation that we did. So luckily, we're kind of prepared for it. As I said, same uses as last time. Payroll costs have to be at least 60% and at most 40% into those non-payroll cost categories. So just overall, again, similar program, a second draw, you need to have the decline in receipts. So when we talk about the application process and notes here, I've Googled it every 2 hours or so, probably since January 1st to see when these things are coming up. No real guidance on that yet. Any lender that was participated in the first draw is eligible to participate and is going to have all of your information available, is going to have all of your prior records available. It's going to be your path of least resistance. Whoever you use the first time, I would probably advise that you use the second time. Now, we will know when this is going to start to become available for most borrowers because community financial institutions are going to get a 2-day head start on this program, basically to try to help serve some of the smaller borrowers and more, I guess, rural borrowers. The SBA came out this morning and said that they will have a 2-day period of limited access, meaning they'll be the only ones who can do it. So we'll have a pretty good, flare in the sky to know when this is going to come up. The lenders are permitted to use the prior guidance and SOPs as prior. When I read through the new SBA final rule this morning, they basically said, yeah, this is 95% the same program for the lenders, for the borrowers. You got this gross receipts test and some smaller employers. The one nice thing they did is they put in a nice 85-page document, which now they said, hey, this is going to consolidate basically all of our guidance into one thing. It doesn't overrule anything that was out prior, but now we have a nice one document to do all this. So the lenders already had these systems set up. They're going to need to put the new application in because it's a second different form. It's a 2483-SD versus 2483. But unlike last time, they don't have to build this back end from scratch. So I wouldn't be surprised if we start seeing applications as soon as Monday or Tuesday of next week. Could it be a little longer? Maybe. But it's not like the first time where we have to build this from scratch. We have experienced a draw. Okay, so now onto the employee retention tax credit. So the employee retention tax credit first came out with the CARES Act. It was kind of the alternative to the PPP program, right? And as part of the Taxpayer Certainty and Disaster Relief Act of 2020, they changed the 2020 ERTC and expanded the 2021 ERTC. And here's your big change. For both 2020 and 2021, borrowers who received a PPP loan are now also eligible to claim an ERTC. So while it used to be one or the other, now you can claim both. The change is retroactive back to March 2020. So that means if you are eligible to claim an ERTC in 2020, and didn't because you had a PPP loan, you may be eligible to go back and claim this ERTC. So that's why I want to spend some time really going on this one, because prior to this, most people were like, okay, give me the PPP. That's a larger amount per employee and just a stronger program. There are some safeguards that are going to prevent double dipping on the PPP and the ERTC. Keep that in mind as we kind of go through all of this. The program has been expanded through June 30th, 2021. It was set to expire December 31st, 2020. They said, okay, we're going to give 6 more months on this. The expansion has changes that don't apply to the 2020 thing. And I think one of the problems that they did was when you increase eligibility going forward and allow for claims that weren't allowed in the past, you're going to have a shuffling of the deck where some people think that the new rules can apply to the old rules, and it's not that. There's two distinct changes here. Changes to 2020 eligibility and expansion into 2021. That's why I tried to use separate terms when I looked at it. So the 2021 terms are for prospective only. They're not retrospective, or not retroactive, I should say. Okay, so the first step in an ERTC, the very first thing, determining if you are a qualified employer. If you're a qualified employer, you may be able to claim an ERTC. If you are not a qualified employer, that's it, no ERTC. It's a pretty simple, flow chart if you think about it that way. You are a qualified employer in one of two ways. You are fully or partially suspended as a result of a government order, or you are experiencing a significant decline in gross receipts. There's those gross receipts again. The fully or partially suspended, there's been some guidance from the IRS. The problem is the IRS guidance comes in the form of an FAQ, which they pretty much put in bold letters at the top of it, cannot be cited as legal guidance, right? Like it's, hey, this is what we're thinking, but if we come back to you, you really can't, take us to court over what we say in this and use this there. That fully or partially suspended is one of those dreaded facts and circumstances determinations, right? Facts and circumstances are, you have to kind of look at the whole picture, get a feel for what's going on, and see how it works versus a more bright line if then test. People hate the facts and circumstances. It's one of those things when you ask your accountant a question and he says it depends, that means it's a fact and circumstances determination. On the IRS guidance, what they're really looking for here was there a more than nominal disruption in your overall operations to allow you to be fully or partially suspended? So they give probably about 10 examples, maybe a little more, a little less. Um, I'm going to cover some of the more pertinent ones, the ones that I think will help people kind of make their decisions to think if they may be fully or partially suspended. Again, it has to have a more than nominal impact on your overall operations as a business. And some of these, I would argue that it has more than a nominal impact, but this is what they have said and how they are interpreting all of this. So, examples where employees have been determined under the FAQ to be fully or partially suspended. You have an auto manufacturer whose key supplier was deemed non-essentials and could not supply the key materials for the manufacturer. So because they were unable to get their key things needed and they could not manufacture because the supplier was non-essential and was subject to a shutdown order, they were considered fully or partially suspended, right? So if you can't get your raw materials because your material provider was shut down because of COVID, that's going to allow you to say you were fully or partially suspended, right? A restaurant that is closed for indoor dining but is open for carry out or outdoor dining is considered to be fully or partially suspended. I feel like the restaurant example is I remember the restaurant example is the one they gave first, the one that I think most people kind of hang their hat on because I think it's probably the easiest for all of us to understand. Um, but they're saying here, okay, you're allowed to continue part of your operation, but nearly not to the same scale and scope as you were because you're not allowed to have people indoors. That is a partial suspension there. They would be eligible. A physical therapist cannot access key equipment, however, has been able to do some limited telehealth consultation services. They are considered partially suspended, right? So you have someone who says, okay, I'm hustling to do what I can to try to do telehealth, but my practice of medicine relies more on physical interaction and key equipment. They are considered to be partially suspended as a result of all of that, right? One that I have firsthand experience with deals with schools that were not allowed to have students, on campus anymore. They were considered to be partially suspended because, no classes, no students were around. I think there's a pretty clear example right there. Here's some cases where there was not considered to be a full or partial suspension. You have an auto repair shop, which is an essential business, whose customers are under a limited travel order. So if you think back to March, we were basically told, all right, don't really go anywhere unless you absolutely have to. Okay, we would be the customers of an auto repair shop. So most of us are not going to get, maybe some dings and dents done or this or that, but they're considered an essential business. Just because your customers couldn't make it did not make them a partial suspension. Now, logically, if the customers can't go, there's going to be a pretty big decline in gross receipts, so they might fall under the other test. Again, this is an or test. You don't need to meet both. You just need to meet one of these two. Um, a software development company that previously allowed teleworking and can have comparable operations was not considered suspended. So I would think this falls under a lot of your professional service firms or anybody that was really able to effectively pivot to a remote environment. Those are going to be the ones that are not suspended. Yes, it would be nice to have people back in the office. Yes, I do miss seeing people's faces in the office, but we as accountants have been able to pretty, not without bumps in the road, but we were able to adapt to a remote working without a real, more than nominal impact on our operations. We would not be considered a partial suspension there. So if you were able to adapt to the telework pretty quickly, and it didn't really impact you majorly, I would say that's not going to be a partial suspension. A retail establishment that is required to limit the number of guests per square foot, resulting in less traffic, is not considered to be a suspension. So if they weren't allowed to have customers in store but could continue curbside and online, that's been ruled a partial. But if you can have them in store, even if a limited number is available, that is not considered to be a partial a suspension. Now, one example that I think is going to be relevant for a fair amount of nonprofits that are in attendance is going to be maybe thinking about, okay, I have been unable to host events or fundraisers or X or Y as a result. And you're looking at that example of the auto shop. You have to remember that is an auto repair shop that was considered an essential business and unable to, because of the limited travel order, have their customers. I think looking at the overall facts and circumstances, the nonprofit as a non essential operation unable to host events or do similar operations there, I think you very much would fall under the partial suspension. Everybody's facts and circumstances are different. I'm talking largely just broad strokes here for people to be aware. Now, the other test that you could potentially look at is this decline in gross receipts. And naturally, there is a decline in gross receipts here and a decline in gross receipts in the PPP. They have to use different numbers because that would just be too easy for everybody, right? So in 2020, if you had a 50% decline in gross receipts in the same quarter of 2019, you are considered to have a significant decline. You are considered to be in significant decline through the quarter, excuse me, wherein your gross receipts are at least 80% of the prior year quarter. So I have an example next to kind of demonstrate that, but the number here is 50% in 2020. So if you don't have that 50% decline, or you don't have that full or partial shutdown, you're not going to be an eligible employee. In 2021, with the expansion of this program, you can now only need to have a 20% decline versus the same quarter in 2019. You can elect to use the prior quarter versus 2019 to take a look at that. So you can elect to say, I am in decline in first quarter 2021 because of the fourth quarter 2019 versus 2020. The writing of that was a little clunky in the bill itself. I would like to see IRS interpretation before we start moving on that particular item. I think the other ones are a little clearer. I think that particular election is a little clunky, and seeing how they implement it is going to be pretty crucial. Still have the same continuation where quarters are, receipts are at least 80%. Effectively, if you hit the first quarter 2021 gross receipt decline, you'll be there through first quarter of or second quarter of 2022. Keep that in mind as you look at that. Again, it's 20% for 2021, 50% for 2020. That change to 20% doesn't affect the 2020 numbers. I've seen that written some places as incorrect. So now looking at this very, very quickly, right? We have these receipts for an organization, right? They had the 2019 receipts, then the 2020 ones, and now they have these ones in 2020. So in 2019, right, the first quarter would not be eligible because they didn't have the gross decline. The second quarter 2020 versus 2019 shows a decline of at least 50%. They are still eligible. In third quarter, their decline only was now 70, was only about 27%. They're still not up to that 80% threshold yet. So they're still eligible. Same thing in the fourth quarter. So once they hit that 50% decline, so long as they don't get above that 80% threshold, they would have been eligible for first, second, and third quarter of 2020 for this ERTC. For the 2021 ERTC, if I look at their gross receipts in first quarter 2021 versus first quarter 2020, they would not be eligible. However, if I look at second quarter 2021 versus second quarter 2019, they would be eligible, right? So I have a decline of almost 25% in that second quarter 2021 versus second quarter 2019. If I use that potential alternative where I can use the fourth quarter of the prior year in first quarter of 2021, that would allow me then to be eligible in first quarter 2021, even though I have only about a 9 or 10% decline as a result, right? So there's a little bit of flexibility here. Again, I'm a little hesitant on an alternative one until we kind of see the IRS interpretation of it, just to make sure that they interpret it the same way that we have, because as we learn with the PPP stuff, maybe they won't. Okay, so now I have this calculation fact sheet for the employee retention tax credit, right? One of the other key changes that came up on the employee retention tax credit was what wages are going to be eligible. So once you determine you're a qualified employer, you are then eligible for the credit at certain rates in certain categories, right? So if you have 1 to 99 employees on either the 2020 or 2021 ERTC, if you're a qualified employer, all your wages are considered qualified wages. For health insurance costs, all the employer portion of the health insurance is going to be a qualified cost. You can do this even if the employees are furloughed, right? This is if you have 1 to 99 employees. The cap for wages and health insurance is $10,000 per employee per year at a 50% rate So you have a max credit of $5,000 per quarter and a max credit of $5,000 per year overall in 2020, right? In 2020, if you have 100 to 499 employees, you only, and if you have 500 or more. So basically in 2020, if you have more than 100 employees, only wages paid to employees not providing services are qualified, and only insurance costs paid for employees not providing service are considered to be qualified, right? So it's that line in the sand is going to be 100 for the 2020 credit. You have to be not providing services if you're above 100. If you're below, all wages are qualified. Again, $10,000 per year is the max. So you have a max credit of $5,000 per year and a max credit of $5,000 per quarter. That's for anybody above 100. In the 2021 credit is where one of the big changes comes up. Now that 100 employee threshold has moved to 500 employees. So that means in 2021, for 1 to 99 or 100 to 499 employees, you have all wages are qualified wages. All health insurance costs, the employer portion only, are qualified costs. The cap has changed now too. It is no longer $10,000 per employee per quarter. I'm sorry, yes, it's still $10,000 per employee, but it's per quarter, not per year. In the above wage cap, it was $10,000 per year. This is capped now per quarter. So that means you could claim $10,000 in quarter one, $10,000 in quarter two of the wages, up to 10,000, I should say. Your credit rate is 70% versus 50%. So that means your max credit per quarter is now 7,000 and your max credit per year is 14,000 because the program expires in June 2021. So now, if you are an eligible employer, you may be able to claim this ERTC up to $14,000 per employee, assuming you paid the qualified wages that need to be paid. That I think, and again, you can also take this with the PPP. And I'll be kind of covering quickly where the PPP interaction is with this program because there are some safeguards. So looking at a very quick sample here, it's going to be tough to go through this. I kind of put this more so people could see it on their own time, but I have an employee one here, who I've paid more than $10,000 per quarter. I got the credit in first quarter 2020. I can't take anything else for second and third quarter 2020, but I can now, assuming I'm eligible, take it for first and second quarter 2021 at a rate of $7,000 per employee, making my total credit $19,000 per employee. I have an employee 3 that I didn't hire until fourth quarter of 2020. I'm sorry, was furloughed until fourth quarter of 2020. I was able to take a credit in second and third quarter for the health insurance I paid. And when I took them off of furlough, I was able to now finish up that credit in 2020. And then as they continued to be employed in 2021, I was able to take a credit for them as well. Now, when we say tax credit, we're talking about a credit against the employer's portion of payroll taxes, and it is refundable, meaning that even if you are a nonprofit organization that doesn't pay tax, you still can get a refund of this credit from payroll. So you claim this via your payroll. It is not done on your tax returns, but rather on your payroll taxes. All right, let's get some. Okay, so now when I talk about ERTC documentation, there are people going to be claiming some specific, you know, specifically high credits, and you want to make sure you have appropriate documentation to support your credit claim. So what I have done and what I have recommended is that if you're going to claim an ERTC, I would have kind of 3 categories here. I'd have my organizational level, I would have my eligibility criteria, and I would have my employee data. So my organizational level data really is a organizational background, information on key revenue and support streams, payroll processes, operational departments, and their functions. Basically, if you were trying to describe your whole organization in, about a page, including these key areas, that's what I would do. I also like to include a little bit of background just so I have it in the report of, hey, we had the coronavirus, New York got hit, or wherever I'm from got hit. We had these shutdowns, a little bit just of the environmental, political, and economic background. Again, I'm not looking to write, the definitive guide on the coronavirus in New York, but rather just having a little bit of background. I find it helps as you read through this documentation kind of get you in the mindset you need to be in. Next, I'll go into my eligibility criteria. I would have identification and a copy of the government order and how it impacted me if I'm saying I was fully or partially shut down, right? That would be key. And I want to have a copy of that available. So I, on my computer, have a copy of all the executive orders from Cuomo that affected New York for the claims that I have done. This way, if anybody ever asks, I have a copy of it right there and I can say what I was looking at. If you're going to claim the credit under the basis of your gross receipts, I would have a comparison of my 2019 gross receipts by quarter with comparison to the 2020 or 21. This way I could easily show, yes, I had this decline as required. Finally, you want to have the employee data. You want to have their name, titles, departments, gross pay, and if you're above the threshold, what services they provide. And again, maybe a sentence on what they do and why they were unable to provide services. You'll want to put the why more in the eligibility area as to what, if they were unable to provide. Um, but you also want to have a little bit within maybe a calculation sheet as well, so you have one master document. You want to have copies of your calculation of the qualified wages and health plan expenses, the payroll journals for the claim period, and the health insurance for the claim period. Okay, so how does the PPP and the ERTC interact? So any wages that a credit is claimed for on an ERTC are not eligible payroll costs, right? So if you claim an ERTC, those costs are no longer forgiveness eligible payroll costs. This is how they prevent the double dipping. That's why when I first started this presentation, I was talking about, hey, there's some new categories of non-payroll cost expenditures. Maybe it's too little, too late, but maybe now if I have some PPP uses, because money is fungible, that were, on non-payroll costs, maybe I now have some payroll costs that are ERTC eligible, and I might be able to get some more support from my suffering organization or business. That's what I was thinking. There's a potential, I don't want to use the word optimize here, but looking at how can I get the most support for my organization. And since I can now claim both an ERTC and a PPP, but I can't use the same wages, I now want to look at it and say, all right, what can I do to, potentially claim an ERTC? Maybe if I, have payroll costs, but I don't need all of them on my loan forgiveness, maybe I put some of those towards the ERTC and use some of these other costs to help offset that to make sure that I'm okay. If you've already gotten forgiveness, the door may be closed on some of that reallocation, but that doesn't mean that any costs that didn't that occurred outside of your 24-week period and or you didn't use for your payroll costs may still be PPP or maybe still be ERTC eligible. When you talk about claiming the ERTC, again, it's on your 941. So you're going to need to work with your payroll processor because either you're going to have to amend your prior 941s for second, third, and potentially fourth quarter, because I know the payroll processors sometimes get them done pretty quick, or the IRS has, or the law gave a provision that allowed people to claim a quote unquote catch up credit on their fourth quarter 941, but that may be too late to already do for most borrowers because it may already be prepared and or filed. The form is not available. And I don't know if it'll be available by the time these things are due. So good idea, maybe poor execution. More likely than not, this is going to result in you amending these 941s and or potentially making these claims on Form 7200 or with an advance payment. Okay. I'm gonna spend the last couple of minutes kind of going the other key tax and business changes that came up as part of these relief bills, right? It was a huge bill, a lot of stuff. These things alone would have been pretty big deals on their own in some cases, but they kind of got overshadowed here. So I want to give them at least a little bit of information. So, number one, you had the expansion of the SBA debt relief program and the EIDL grants. So the SBA debt relief program originally offered 6 months of principal and interest on existing SBA debt. That includes 504s, 7A, and SBA microloans. This program now includes 3 more months of these principal and interest payments starting in February 2021. So if you had an SBA loan that was getting paid for you, kind of got picked back up in December, starting in February, you get 3 more months of principal and interest paid for you. So existing SBA borrowers are getting a little bit of relief. The EIDL emergency grants. If you recall, we kind of highlighted these earlier. People were offered a $10,000 emergency grant when applying for the EIDL loan, regardless if you were approved or not. The new package now includes funding for this additional $20 billion in funding for this program for those who have not yet applied. So if you haven't applied for an EIDL yet, you may be interested in seeing what the terms are, but you also may want to apply for the EIDL emergency relief grant. Again, this no longer affects your PPP forgiveness either, so it really is kind of just a free grant. The tax treatment of those grants and the payments was clarified too. They were materially given the same treatment as the PPP forgiveness loans, which I found kind of surprising but kind of interesting. So the 6 month payments that were made under that and the other 3 months for the debt relief program, they will not be denied any deduction and they will not be included in gross income. So those 9 months of payments from the SBA are not taxable income to you. They're treated the same way as a forgivable PPP use, which, you know, I found a little maybe unfair for people that didn't have SBA borrowing, but great for people that did. The emergency EIDL grants and the EIDL advances under the CARES Act, those $10,000, are also not going to be considered gross income. They are going to be considered tax exempt income. So that $10,000 is now just a literal free $10,000 if you apply for these EIDL loans. Now, early on, I was telling people, be wary of the EIDLs, get your PPP first. I could see them potentially coming around and saying one or the other, get the better program first. Well, a year later, that still hasn't happened. So, if you think you may need an EIDL or may be interested or, just want to get the emergency grant, it may be interested in applying on the SBA website for that. There was an extension of the unemployment relief for governmental entities and nonprofits. So part of the CARES Act, any reimbursement nonprofit that has to pay the direct costs charged back from New York State or whatever state they're located in for unemployment was given a 50% relief by the federal government. This was originally set to expire on December 31st, 2020, and has now been extended to March 14th, 2021. So for reimbursement employers, that relief is still out there now through March. Um, New York State has said that reimbursing employers should only remit 50% of the amounts billed and can ask for prior overpayments to be applied towards open bills. Now, I haven't seen formal guidance on this, but I've heard it from several organizations. I've heard it from New York State when I called to ask a question for one organization. That's how this is going to work, that if you are one of these reimbursement organizations, you can, if you were paying the 100%, ask for those overpayments to be applied towards your new bills or only remit 50% on the new bills. Any overpayment that don't get applied in the future, I don't have an answer as to how that's necessarily going to work yet. Okay. We have an extension of the paid family leave and sick credits. So the first Coronavirus Act passed, quickly overshadowed by the CARES Act, was the Families First Coronavirus Relief Act, which created a sick requirement to offer sick and paid leave to certain coronavirus impacted employees. Basically, if they were subject to a government or a healthcare order to quarantine, if they were caring for someone who was subject to a government or healthcare order to quarantine, or they had a child who was unable to attend school because school was closed because of COVID. They required you to provide this sick leave or paid leave and also allowed a tax credit to make the out of pocket costs of the employer nothing. So you would get up to $511 per day for 10 days. You would have to pay the employee and you would get a credit for if they were advised by a healthcare provider or a government order to quarantine. You would get 200 per day, up to 2,000 for 10 days to care for a family member who under a quarantine order or for caring for a child whose school is closed, and up to 10 weeks at 200 per day or 10,000 for a child whose school has closed. As of December 31st, you are no longer required to provide these leaves to employees, right? It was required prior to December 31st. Now, if you do, you can still claim these credits, assuming you comply with the program otherwise, but you are no longer required to provide it. So it has to be an employer choice of saying, okay, we still wish to provide leave in this manner. We are still going to comply with this program and be able to claim the credits, or say we are not going to, offer this leave. Maybe you have a separate leave policy. Just know you won't be eligible for these particular credits. Okay, we have the 100% meals deduction. Starting on January 1st, 2021, taxpayers will be allowed a 100% deduction rather than 50% for food and beverages provided at a restaurant. You'll notice I have a restaurant in quotes. So there's been some questions as to, well, what's a restaurant? Is Starbucks a restaurant? I think prior to guidance, use your best judgment, but I'd imagine they're trying to um, help with the restaurant industry in any way they can. And I think Starbucks and the like still have the same hitting. So if it's a place where food could be provided in a sit down capacity or a takeout capacity, I would say it qualifies as a restaurant. Use your best judgment. Just want to highlight this didn't change the requirement to still have a business purpose and meet all other requirements to have a deductible meal. So don't think this now means, okay, let's go to dinner with my wife and I can now write that off at 100%. No, it still needs to be an eligible business meal, have a business purpose. You need to keep your documentation, so on and so forth. Okay, two more and then we're done. We have the student loan relief payments. So this passed as part of the CARES Act. There's something called a Section 127 tuition reimbursement that allows employers to give to the employee tax-free, but still take a deduction for $5,250 per year to use on tuition, subject to a plan which must meet certain non-discrimination requirements and cannot offer an alternative of benefits, right? It's called the Section 127 plan. It can be an interesting tool for a lot of employers trying to attract or retain talent, but it can only be used to pay tuition. The CARES Act said, okay, a lot of students are struggling with student loan debt. What can we do? I know, let's expand the Section 127 plan. And they now allow employers to pay, and along with tuition, student loan payments, either direct or with documentation of the same amount. So now employers would be able to, in theory, spend up to $5,250 per year per employee, tax-free to the employee, tax deductible to the employer, towards student loan payments, which I think right now, with everything going on, it's tough to offer a new program and new benefits. But maybe in 2023, 2024, as this now goes through just 2025, this could be something that's interest to employers as they look to find, unique and tax efficient ways to compensate their employees. Lastly, and this has probably already hit most people if they were eligible, we had the additional economic impact payments, right? So the first payments came through back in April or May of 2020. You now have your second payments, an additional $600 per taxpayer, basically at certain phase outs, with an additional $600 per qualifying child. I just want to highlight on this. This is not a one-time use it or lose it payment. This was an advance of a 2020 tax credit. So if you've maybe had a child that born in 2020 that wasn't on your 2019 return, or your 2020 income is down significantly to your 2019, you wouldn't qualify on your 2019, but you would in your 2020, you are eligible to claim this when you file your tax return. So just keep that in mind. This is not use it or lose it. If you were supposed to get it and you didn't, and you'll be able to have a second bite at the apple with you file your tax returns based on your 2019 tax data. All right, so that kind of covers our presentation. Again, a lot to take in. I saw questions popping up. I think Matt and Ken have done a pretty good job of answering the majority of them. I'll see if any more are there.
Yeah, Ed, we left you. We left you.
Okay, cool. If I got an EIDL loan already but declined the emergency grant at the time because of PPP, can I now just apply for the emergency grant? I would say unlikely. I think that's still going to be part of the loan package as a whole. So I doubt you'll be able to, but I haven't seen anything that says yes or no, but my initial feeling is unlikely when it comes to that. The $10,000 from the EIDL should be included in the calculation of gross receipts for the PPP application then. That was not specifically covered. My instinct is no. I would say that probably should not be included in there. If that was going to make an impact, as I would be plus or minus a 25 or 20% that I needed to, I would exclude it. I think that is their intention to exclude it across the board. So I would not say that that's going to be included in your gross receipts. Can you apply for an EIDL and receive the grant even if you do not qualify for a second draw PPP loan because you have not had the required decline in revenues? Yes. The PPP second draw and the EIDL are completely separate programs. You could apply for the EIDL having never applied ever for a PPP loan. They have a little bit of interaction and crossing of the streams in the parlance of Ghostbusters, but there is no reason why you couldn't just apply for the EIDL and potentially receive the grant. Regarding tuition reimbursement, does the employer need to pay in lifetime when the student is in school, or can it pay back school loan post-graduation? So a tuition reimbursement program has to be paid for tuition in lifetime. The student loan relief can be used to pay student loans that the graduate has taken out. So I guess your answer is kinda, but you can either pay tuition in lifetime or you can pay it on the school loans afterwards. Now, just remember one thing on this program. It's $5,250 and it's open to everybody. So you can't just selectively say who gets it or this or that. It has to be an open enrollment, cannot favor the highly compensated. There's a fair amount to it. And one thing that I'm unsure of, because I haven't dug as deep into this program yet, is how would the dependents work on that. I think dependents do not work because they typically don't work for a tuition reimbursement program. So I would say the same applies here. How does staff retention work with the second draw? If he hit the button too fast. If I use my 2019 payroll when I had more employees, will I be denied a second draw now because I only have a handful of employees? No, that has no impact. Again, the number is still the number. You can use whatever payroll number you want. That staff retention will not have any impact. So keep that in mind. The decon employees will not have any impact on your ability to apply. Can you apply for a second EIDL if you already received 150,000 as this amount was automatically capped? There isn't a second EIDL, but rather just a continuing of the EIDL program and the grants themselves. So there is no second EIDL loan. Sorry if that was confusing. Okay. How does a nonprofit apply for the ERTC? The nonprofit applies the same way any other employer would apply. You do it through your payroll tax filings on Form 941. The ERTC is a reduction that is refundable of your employer Social Security tax liability, and then can be used and can be completely refundable to you. So you would just work through that with your payroll processor and your accountant. Cindy, the best way to let us know you want to apply for the loan is just to shoot me an email, just like last time. I'll help you out again. um, if you received a PPP loan in April and haven't applied for forgiveness and now apply for a second PPP loan, when do I apply for forgiveness? What is the deadline for the forgiveness application? Okay, so second PPP loan has the same forgiveness as the first PPP loan, meaning you have a 24-week covered period. You have 10 months after the covered period. Your first loan still under the same terms. You had the 24-week covered period, and you have up to 10 months after the end of your covered period. So nothing changes on your first PPP loan with the forgiveness, and the second one applies under the essentially same terms. Is a new employee hired in 2021 eligible for the ERTC? You know, I haven't looked into that as much. I recall reading there were some safeguards on employee length of tenure on the ERTC. They were relatively short on the 2020 ones. I don't know off the top of my head how the 2021s would work. 2021 new 2021 employees would work. I can't tell you. I didn't remember seeing it anywhere, but I also wasn't necessarily looking for it. What is the covered period for forgiveness of the second draw? The covered period for the second draw works the same as the covered period for the first draw, meaning you have there was a slight change, but it's a mechanical change. You can use it for any amount of time between 8 and 24 weeks after your initial loan disbursement. So it literally is just a second draw on the PPP loan. It works the exact same way. Your covered period can be any time between 8 and 24 weeks. If the current PPP loan is yet to be forgiven, can you still apply for PPP loan 2 prior to forgiveness? Yes, you can. There's no need to apply for forgiveness to get there. Can we start with this current payroll for ERTC, or are there official regs that need to be issued? You can technically start on this, although again, I don't know how you would know you are an eligible employer in the first quarter unless you have the qualified shutdown or that to do that. But yes, you could technically start on your ERTC right now. There is no reason why you couldn't. The tax-exempt income on an S-corp basis is just considered an increase to basis. So that's when you have the forgiveness, that's when you create the increase to basis. That's what I was saying. You may have an issue on S-corporations where if you don't have forgiveness in 2020, you may not have that increase in basis until 2021 when you get the forgiveness. Okay, so that being said, no other sorry, there we go. 10 more questions just popped in. Look at that. Is a new employee hired in 2020 eligible for the ERTC? Again, there were rules specific to the ERTC when it came to new employees. I don't have them necessarily offhand. I can't tell you that one offhand, but I do recall there being some minor rules. I think it was like a 30-day rule or something like that. It was a relatively low time frame when it came to all of that. Can we reduce payroll by 25% again? As far as I understood, all of the terms and conditions from the first program still apply to the second one. So yes, that should still be fine. Do you advise applying for forgiveness for the first PPP loan before applying for the second? I see no need to necessarily apply for forgiveness on the first one before you apply for the second. I think that you should apply for forgiveness when you now feel ready. I think most of the changes that are going to happen have probably already happened. So, you know, My focus would be to make sure I secure a PPP2 loan before I spend my time on PPP1 forgiveness, because the PPP2 loans could potentially run out, but there's no reason that you can't apply for forgiveness and do both at the same time. If a business is incurring expenses now, can PPP2 proceeds be used to pay them once the proceeds are expenses paid in January, proceeds received in February, March? No, the eligible costs are going to be paid or incurred during the 24-week period. So if you paid it prior to receiving the loan, it won't be an eligible expense. So to be clear on the forgiveness period, I received a loan, in May, covered through October. So 10 months after this is a deadline. Yes, 10 months after the end of your covered period. If the ERTC is more than the payroll taxes normally remitted on the 941, how do you get the additional funds? Frankly, you pray. You would be issued a refund check on your amended 941. That's why I'm hesitant on the amending the 941s, because number one, it's a pain, and number two, that could take 6 months to get those. They have a way that you can get those overpayments if your taxes are not enough. It's called Form 7200, but it has to be done before you file your 941. So any past ones, you won't be able to get that. For 2021 ones, you can file Form 7200, and they're also discussing a potential advance payment mechanism for these as well. Want to see the regs on that before I really start talking about that, though. When does the PPP Loan 2 application end? March 31st, 2021. If we have not applied for PPP forgiveness yet, can we backtrack our health benefits fringes to the first PPP? Not quite following that. Health benefits were always included as payroll costs in the first PPP. If they were paid and incurred during the covered period, they're eligible costs. Yes, the increase in basis should only be once the PPP is forgiven. What is the deadline for forgiveness on the first PPP loan? 10 months after the end of your covered period. After we receive the second loan, do we need to pay back the difference to the employees? If the wage reduction is not more than 25% and we maintain employees more than 40 hours per week, not really following your question there. You don't, the same terms on the first program apply to the second program. I understand we can't apply for ERTC for same payroll expenses we are applying PPP funds against. But can we apply for ERTC for payroll expenses incurred after the PPP covered period? If you are an eligible employer, absolutely. That's what they're trying to do. That's like the nail on the head, so to speak. All right, I think with that, we are going to end our webinar. Again, thank everybody for their participation. I hope this was helpful and informative for you guys, and wish you the best of luck. Thank you.